What is going on, Hot Take Nation? It is DRW here for another episode of the Hot Take of the Day podcast. Today, we're very fortunate to be joined by David Forsberg of Ascent Ventures. We're going to learn about, I think, a lot of things. A little bit on the quant side, a lot about investing, get his take on what's going on in oil and gas. But before we get there, let's start with the last week. We've seen some bankruptcies, extraction declared. We've seen oil come back to 40, then go back to 38, then come back to 40, and we're in a very, very choppy and volatile time. The thing that brought me back from my vacation, in case you were curious, there was going to be a gap in the blog between season 1 and season 2. I didn't know how long it was, but in my mind it was going to be September. But then I started getting text messages from people, love Hot Take Nation, love the info they provide, and that companies were starting to think about picking up rigs again. Like, have we learned nothing? So DRW had to go right back to November 2018 and say, operators, what in the hell are you doing? We can't be picking up rigs right now. So, David Forsberg, welcome to the show. Let's start with that topic. Have you been hearing about people picking up rigs?
I've heard a little bit, but I think it's still pretty light. I think that the picking up rigs noise is greater than the actual reality. But we'll see what they actually do here in the next month or two.
Do we call that like the old bait and switch with service companies, trying to get them to lower their prices, saying we're about to pick up some rigs, and maybe if you could just do me this one solid right now, we'll pay it back in spades when the rig comes? Is that what you think's going on?
Yeah, and if you need to get in line, you get in line early, right?
Well, there's enough equipment that the line should be short. Now, you have to be socially distanced in the line, of course, so spend at least 6 feet away before you sign the contract. So, David, why don't you talk about Ascent Ventures and what you're doing and how you see the energy market today?
Sure. Ascent Ventures, we're a venture fund focused on investments in energy technology companies that lead to a more digital and automated energy industry. My background is in automating financial markets. I began by working with a famous investor named Joe Ritchie, where we developed execution algorithms used by institutions, ranked #1 by institutional investor, and we did about 100 million shares a day eventually. And then we started doing investment algorithms, systematic processes, with a joint back office agreement with Goldman Sachs. We ran about 100 million long short, probably 50% in E&P stocks. And then I was the head of investments for a single family office related to the E&P industry. And there in 2015, we were well positioned for the sell-off in crude prices, but just couldn't find assets that fit in our wheelhouse that were at a fair price. So we decided to figure out where we could add value. And we felt that the trends that happened in other industries, in particular the financial industry of automation and digitization, were coming to industrial sector and specifically the energy sector. As one of the biggest digital laggards in all industries, we felt that there was an opportunity there. And so we liquidated all of our E&P assets in about 17 and redeployed some of that capital into investments in the space. And so it's just been an evolution since then.
So a lot to dig in there. Let's start with 2015, when you looked at opportunities to divest of E&Ps because you couldn't find anything. So you're running a $100 million fund. How do you think about the valuations, if you stay on top of them, of E&P today versus 2015? And what do you make of it?
I think valuations are bizarre. I think valuations for assets across all asset classes are in many ways bizarre right now. I think risk is high, volatility is high. It should be, as a discounting mechanism, those two pieces should be repositioning asset prices across asset classes. But I think it's bizarre.
Yeah, one of the things, and we talk about this a lot because, you hear a lot of investors and certainly people in the industry get excited about 40 because 40 in and of itself, I would argue it's not economic for full shale development, but certainly it's economic to complete some of the 7,500 DUCs we have in the country. And to your point on discount rate and valuations, I mean, I looked at Amazon the other day because I keep looking at the NASDAQ being like, how can you not short it? And this is not a show about investment advice, but Amazon is trading at 126 times forward earnings. And the last time I checked, notwithstanding computing and Amazon Web Services and all this stuff, but last time I checked, consumers have to have jobs to buy the things that are being sent to their house. And so I look at Amazon and I feel like it's 2000, but at least Amazon has very low debt. You transition that to the E&P sector, and even if you were to use a 0% discount rate for equity, everyone has so much debt with the exception of maybe Pioneer and EOG that you just can't survive your debt long enough to get to a place where prices are higher. And yet asset prices, and I mean equities stay so overvalued. Do you see it the same way?
Yeah, I think you've absolutely hit the nail on the head here. I mean, if I were investing in E&P stocks right now or publicly traded companies, I'd be buying the debt. That's what I'd be looking for. Not so much that I think that I want the debt, but I'd be looking at it to convert into equity.
Yeah, and I totally agree. I think that there's definitely a bifurcation now where, hedge funds and certainly private equity guys are realizing that all the rock in the United States worth owning is owned. Yep. And most is burdened by so much debt and or firm transport contracts that make it totally unable to buy it, and or, wellbore abandonment liabilities that are so ridiculous that the only way to really do it is you move through the debt, and then once you go through bankruptcy. It'll be interesting to see in a case like Extraction, which is a Colorado company, obviously, if the creditors push that management team out, given that, that's been the management team that took it from private equity to public. I think they went public and their valuation was maybe $4 billion. Do I remember that right?
That resonates with me, yeah.
And then zero now for equity holders. So that's sort of 2015. You and I are aligned very much on that. Let's talk about technology. A lot of people really look to technology to unlock, like as we go to lower personnel and more challenging economics, we see the digital oil field as being transformative. In my career, I really haven't seen that. So I'm curious as an investor how you differentiate the whizzy-bangy thing that might be not really a game changer versus a true game-changing technology in the oil field.
Yeah, I think the first thing is what are we talking about with technology, right? In oil and gas, there's the first bifurcation, which is more engineering tech, so hardware, things that are in the field. Then there's a digital or asset light tech. And then from there, there's a separate bifurcation, which is operational tech versus field tech or drilling tech. So that is where I focus, is on the digital side. So, and we've been very heavily invested as an industry in the engineering side, which has made sense. I think that it's going to be kind of like a how do you eat the elephant scenario, where right now we're sitting around looking at the elephant and taking some of the E&P companies are taking small bites, and in 10 years, 5-10 years, they will see huge benefit from, and they will have eaten the whole entire digital oil field elephant. They'll be much more efficient. They'll compound capital better than their peers. And the other people, the other companies, they will have not even started because the bites were too small. And they'll look around and say, how did this elephant get consumed? And they will now be way behind their peers. So I think that we're going to see, and I think eventually there's a play here in public equities as well between those that digitally adopt and those that don't. So in my opinion, it is time. The energy industry has been the biggest digital laggard of all industries behind the public sector. The executives feel that they have FOMO about possibly missing out on this trend. And so I think that it's not a single technology that we'll point to, but in 5 to 10 years, we're going to be very surprised and impressed by how this stuff has evolved.
Yeah, it's really interesting to me because I reflect on my career and I'll put a couple things out there. But one of them is our industry is not that hard. Now, it's very capital intensive, and I sort of used to make a joke that drilling wells is easy. Producing wells for 30 years is very hard because you have H2S, you have people, you have equipment, you have leaks, you have all the things. But like the old private equity model, which was really the feedstock of this resource growth play in the last 12 years, like it was find land, prove it up through drilling wells, which was easy. And quite frankly, you could use Excel, pen and paper, and get the wells drilled. But for a company like an Exxon, where you have just this massive, massive legacy, it's hard to envision how one of the super majors, who will obviously survive the downturn as a lot of the small mid caps disappear, it's hard to imagine how an Exxon or a Chevron would really adopt this in a meaningful way that transforms their business. What do you say to that?
Yeah, I'm not entirely sure that they're the target market for much of this technology. I think it's the other, call it 8,000 E&P companies that exist at different levels. The big majors have already, they have the ability and have done so to build their own internal technology that gives them an ability to manage at scale. It's the other companies that haven't. Take you, for example, David, your past, you used a CRM. That was a strategic advantage for you, whether you realize it or not.
No, it was, absolutely.
Yeah. So Teams, using Microsoft Teams, using Slack, using other tools that are just accounting software. I looked at an E&P company that's operated for 40 years, and they were still keeping their books in pen and paper just because it was easier. And this isn't that long ago. So I think that those opportunities to bring it just up to other industries exist. And instead of hiring 6 accountants, which you've now laid off 5 of them, you're going to say, okay, well, which are we going to bring all 5 back? Or maybe we should look at some of this software so we don't have to bring any of them back. So I think that's where the trend is going to go.
So I'm actually glad you raised that, because that's something I haven't talked about. I mean, I did a post a couple months ago sort of reflecting on One Energy and the whole work from home. And in 2016, because the 4 partners were in 4 different cities, yep. We elected for various reasons. We saw the competitive advantage of having someone in New York, someone in Houston, someone in Dallas, someone in Denver. And the view was we could have a meeting with basically anyone in the energy industry and be there within 2 hours. Yep. And not the G&A savings. And when we would tell people this, everyone thought we were crazy. And so it was so bad that we had a fake office in Houston that was the AIG building, which we affectionately call the One Energy Tower. And we just had a Regis. Like we were never there, and we would have people show up with like kolaches that they would hand them out to like every other business. But we were able to work from home. But you're right, the competitive advantage for sure that we had that enabled that to work was we used something called Pipedrive. Yep, which was a CRM tool, and it was and Leo, I think really led the charge on that in transforming it into every single call, every single meeting, everything anyone had, you documented, and it would auto email a summary at the end of the day of everything that was done, so that we never had any meetings. So like a lot of people talk about being bogged down in meetings, and they discovered that on Zoom, they really didn't need to have 3 hours of meetings a day, and their boss was actually available to make a decision. Well, the reason we were able to get away from that was everyone knew everything all the time. And if you wanted to read more, you just went in the tool. And you're totally right. That was transformative. I see how that would work. Yeah.
Multiply that out across, right now there's hundreds of small energy tech companies, digital technology companies, and they were founded oftentimes in the recession, the oil and gas recession of 2015. We're going to see more companies be founded. These are guys that are people who have worked in the industry for 10 plus years. They've realized there's a pain in the butt piece of their business, of how they've operated, and they're going to go and try and start a company that resolves that little piece. And so then we're going to get consolidation, and then we're going to get them all into some sort of unified platform that you just subscribe to, and maybe that's like a Bloomberg terminal or something like that for E&P that allows you to have multiple data feeds, and suddenly efficiency gains and ability to operate at scale, do more with less, becomes a reality.
Do you feel like you need to bet on not only the winners in the transformative technology as an investor, but you also need to bet on the companies they're targeting? Because one of the things you commented on was there's 8,000 E&P companies. I don't know if that's the right number. I'd heard it was lower, but it's a lot. And I've made the case probably for the last year and a half that I see a world in less than 3 years where there's only 10 large E&P companies left that are public, and there are perhaps 10 privates. And when I think about a private, I think about a Hillcorp, or I think about like a pension fund like CalPERS, who would invest behind a guy like Sky Callantine to put like $5 billion to work to consolidate assets in a basin that public companies don't want. But in that scenario where there's only 20 companies really left and all the land is owned and it's just a slimmer industry, how do you pick the winners in your investment thesis? Or do you disagree that the level of consolidation gets that tight?
I think I disagree a little bit with how tight it gets. I think there will be consolidation, but I think that one of the biggest companies is yet to be founded, and it'll be a company that uses this digital technology to operate at scale. And they will go out and they will consolidate and acquire a number of assets that they can operate far more efficiently than anybody else. That is both in their back office operations as well as their field operations. And I think that company is yet to exist.
I agree with that. I think that's a really good point. So when you look about, we talk about how slow the oil field has been to digitize and the difference in industries. Is part of it because we are a bit of a legacy and a boom and bust? So like when I think about inventory remaining, one of my biggest challenges, even coming up with who wins in this, is that I have had the view that the Bakken might have 2 years of inventory left at the pace we were running at the number of wells that should have been drilled. And so now with economics revised and rigs down, like you sort of say, well, there's nothing left to do other than just produce out the asset, which again is very hard operationally, but from a digital standpoint, maybe not as hard. What do you think about that?
Yeah, I think the E in E&P no longer stands for exploration. It stands for efficiency and economies of scale. And the industry is migrating to a more manufacturing process. And if you look and you think about it, what the technology that enables that manufacturing at scale tends to capture a disproportionate amount of future margin. So the Barclays came out with a report in January on the digital oil field. I think it's called Frack to the Future. And it says that they think the current revenue for the digital oil field is about $5 billion today, and within 5 years it'll be $30 billion. And then they think that there will be $3 per barrel of savings to the E&P companies with $150 billion a year. Okay, just threw a bunch of numbers at you. But I think that it's wrong in the fact that $150 billion of savings to digital to companies, that will go to these digital companies that have a strategic advantage in their technology and allow these companies to operate in that manufacturing environment. So to me, I think that the digital oil field is a great way to participate in this shift that you just alluded to a more manufacturing process.
What do you think about the fact that an investor or a major company, one of the big five, certainly, I saw a stat on CNBC yesterday that the top 5 companies, so that would be Amazon, Apple, Microsoft, Google, and I can't think of who the 5th one was, but the big 5. They're $6 trillion in market cap, which exceeds the combined market cap of the other 495 S&P members. And one of those, Google, has said that they won't provide, I guess, investment in oil and gas. Was that like a PR thing? Were they just not doing a lot of business? Like, what do you make of when companies make this clean energy pledge or whatever they're doing?
Yeah, so Greenpeace came out with a report chastising these companies for their use or creating tools that enable the oil and gas companies to operate more efficiently. And Google is the only one that folded to that. And the main reason is that Google is 3rd or 4th in cloud computing, so they're a laggard there. And where Amazon is the leader, and I believe Microsoft is number 2. So it wasn't a big deal for them to back away. So it was low cost, high PR, and it fit within their company desire, their employee desires. And so I don't think it's a big loss, first of all. But I think it was more PR. But if you'll notice, I don't need Google to create AI tools when there are 100 oil and gas specific digital companies that are creating AI tools. So I think that that's kind of a red herring.
Yeah, that's totally fair. Let's pivot and talk, because of the technology topic. I do want to talk a little bit about COVID, not the virus, but what we've learned. And one of the things that I come away from this regardless of Amazon's valuation, Amazon is so big that I remember when I was younger in my life, Microsoft going through some antitrust issues, and it was specifically around Internet Explorer, which was their product, and I believe that the competitor was Netscape.
Yes.
And there was some antitrust because Microsoft could basically do whatever they wanted and everyone had to do it. And so I look at Apple and my inability. I hate Apple. I truly hate Apple. I can't use their computers. I don't even know how to turn them on. But I have an Apple phone because I'm like linked to their app store. And then they're tracking me, and they pushed out like a COVID data tracker the other day. And then Google's automatically deleting my location history, which I didn't even know they were tracking. And then Amazon just crushes all the small businesses, and we can argue that they facilitate small business sales, but what I've heard is they're like Walmart, and that they're very, very prescriptive on what you will do and what your takeaways and what your returns and etc. And the reason I bring all this up is, do you think that innovation is being stifled in our economy when you said in the oil and gas you have small AI guys because no one's competing and they can kind of innovate, whereas these other big guys have a business model, and anyone who even starts, they could just go pay them $10 million to stop, and like it becomes an antitrust issue. And I don't think I appreciated how big an antitrust issue we have in the United States until COVID. I'm curious if you have any opinions on that.
I think antitrust is more of a legal component, and so I don't know that I comment whether it is or isn't falls under the legal antitrust. But I will say this: I think that there is a component to all of these big companies that stifles growth because they are modern monopolies. They are platform businesses. Facebook.
Facebook was the other one, which I can't even believe is still a business, which is why I reject the premise it's one of the top 5 largest companies in the world, but there it is.
Yeah, the FANGs, there's a great book. It's called Modern Monopolies, and it talks about this. It's a fabulous book. I think it's the yellow book behind me. But they discuss what platform business model really is, and these platforms, once they get scale, become monopolies. And so you're 100% correct. Now, that doesn't mean monopoly doesn't necessarily mean that it's detrimental to the consumer or to society. It just means that it does, to a certain extent, stifle competition. And if you look, in fact, there's a great book called The Master Switch, and it talks about the evolution of the media monopolies from Western Union to the phone to cable to networks, et cetera, and radio, and how they took certain steps to protect themselves. So is Amazon taking steps, and is Facebook taking steps to protect themselves from competition actively? Whereas Microsoft took active steps to keep any other company from operating, and so I think there's a slight difference there. But no, you're right. I think it's something that our government is certainly involved in, which I have mixed feelings on that. But yeah, I think that there is some issues there.
Yeah, I mean, it is funny, and I mean, I don't think anyone would ever describe me as not a Republican. I might be a socialist Republican because of my Canadian family heritage, but I would never have been in favor of breaking up Apple, Amazon, Facebook, Microsoft previous to COVID. But then, like, when I was at Home Depot, for example, and Home Depot was open, but the florist was closed, and you know that is related to the number of employees they have, the access they have to politicians in terms of how much they contribute to their campaigns and how much they matter in terms of employment. And you need to look no further than when Amazon was trying to have 2 headquarters, and like it was this national search and everyone was competing. So it's no surprise that Amazon was allowed to sell all of the products that other places weren't allowed to sell. And that to me is just, as our economy has slowed so much and as employment is a challenge, I really am concerned that unless you break these big companies up, you just end up with these monoliths that can do whatever they want, and you can never get back to full employment. And but anyway, I mean, it's a little bit of a diversion, but it is interesting given the technology elements when you think about like what Facebook and Amazon, the narrative they control, and the media, what narrative they control vis-a-vis everything else that we're trying to accomplish.
Absolutely. Absolutely.
So go back early in your career and, talk about how you ended up in this road. As you look back, I'm sure it makes sense, but as you looked forward, going through a family office and running a long short investment fund and then investing in technology, what were the key 3 or 4 pivotal moments in your career that you can remember that really guided you to where you are today?
I think so. I think of the world as one bucket of skill, one bucket of luck. Okay, you can do whatever you can to maximize the skill bucket, and those are things like whatever, get a degree or interact in certain ways, read books, whatever it is. And then there's the luck, which is the randomness bucket, and that's positive and negative. Okay, and whenever we take any action, there's a component of uncertainty to it and a component of skill. And I think most of my career has been more randomness than any sort of diligent plan. And I think that's true for most people, whether they truly understand that or not. As an investor, you have to understand these different components to outcomes, which is randomness and uncertainty, as well as skill. So my career has been a factor of that. One pivotal moment that I think was important is working in automating financial markets and understanding as the tip of the spear what it looks like when an industry, one, pushes away for the technology and eventually gets run over by the tidal wave of that adoption, and what it takes to really digitize an industry. And the macro trend, which I think is the dominant trend of my lifetime, is automation. Things are going to become progressively more automated, whether that be, it doesn't necessarily mean digital either. Like if I set up a schedule that says I wear a red shirt on Tuesday, that's an automated process, whether it's digital or not. And I think that the human mind and our society is migrating that way for multiple reasons. And so that's the trend that I think, or that part of my life allowed me to see that trend firsthand.
It is interesting that you talk about the randomness, and Guy Raz on How I Built This, which is one of my favorite podcasts, always asks at the end, is it more luck or skill? And it is funny that a lot of people, like, they really want skill to play such a factor, whereas I really think that so much is luck, and there's 3 or 4 meetings, and I think back in my career, there was a headhunter that I was talking to in 2012 when I sort of suspected that my impending termination was coming. I didn't believe it was going to happen, as most people probably don't. They're like, I'm not really getting along with my boss. I never talk to my boss. He kind of avoids me, but I'm sure it's going to be fine. But I was talking to a headhunter, and that headhunter, through him, is how I met all of the people that I ultimately did One Energy with 4 years later. And just his sort of involvement in my river was so impactful to where I am today. And that is not a skill thing. That was a 100%, like, I had the skills to be in the position that I was in, but it was total randomness that I met the 2 partners I started the company with, that I learned about private equity from. That was what the book was based on. So it is interesting that you see the world very similar to me in that way.
Yeah. And my career in life has been influenced so much by serendipity, which is what that is. And I think in that Guy Raz question at the end, as human beings, we tend to there's a matrix that I think of. There's good outcomes, negative outcomes, then there's good decisions, bad decisions, and that's data-driven decision making and those kinds of things. You can have a bad decision with a positive outcome, and you can have a good decision with a negative outcome. If I flip a coin and we know it's going to be heads 70% of the time, any bet on tails is a bad bet, but it still is going to show up on tails with enough samples. It's going to show up 30% of the time. So you're going to be wrong a percentage of the time, even when you made a good decision.
So you talk about data driven. Let's talk about your investment process, both historical and current, because I agree, and I think a lot of people forget that, and I learned this playing competitive sports was it's not the outcome that, I mean, the outcome obviously matters, but to get a consistent outcome in sports, you need the correct process. And in business, the correct process leads to the correct decision making. And sometimes you can for sure be wrong. And you know, I've talked about this, you know, I came into this year on the belief that oil was going to be 60 because the US was going to decline because we had maximized length, we had drilled too tight, and declines were too high. And I wrote about that in October. And so I said, so look, the US is going to decline 1 million barrels a day when the world thinks we're going to grow 1 million barrels a day. OPEC has defended a good price, and therefore oil will be 60. So if you buy companies that are exposed to the best business model at 60, you win. What I was wrong on was COVID and demand destruction and everything that came out of that. So I felt like it was a good decision at the time, what turned out to be the wrong outcome. Curious, as you think about the good and bad and you're data driven, how you look at it, things you've learned over the course of your career.
Yeah, just to respond specifically to what you said, is that, you know, it's a Bayesian update, right? And if you're a data-driven decision maker, you almost naturally go and seek out new information to help poke holes or to update your data, so that way you can refine your message. So when you made the decision, you didn't know that uncertainty was going to happen, and suddenly COVID happens, and so you need to reevaluate and update your investment thesis with the new information that is COVID, and what does that look like going forward? And plenty of times as an investor, you're wrong, you pivot, and you're suddenly right. Okay, because new information came in the door. So the way that I think about my decision making, and there are different ways to do this, but you know, one, the scientific method is a very effective way of thinking about things and applying it to things other than science. But I think about, one, developing a forecast. And what does that forecast look like? What factors am I considering? How do I adjust things? There's a great book on that called Super Forecasting, and it's more of a process of your forecast to just refine it a little bit. There's still going to be an error term and an uncertainty. And then it's kind of judgment. You gain judgment through skills, through education, through tracking and analyzing results. And then once you have that judgment, you apply things to some sort of a model, whether that be an investment process or a decision-making process. And then you make your decision, and then you have your results, and you need to adjust and adjust the model and think about reasons why your results were positive or negative. What did randomness do or factor into that decision-making process? And if you are robust and thorough in this type of a process, over time, your decisions improve, and it's probably the number one way to compound and improve your life is through really looking at all of these things and more systematically. So, and using data, obviously, instead of just feelings, because sometimes feelings are related. Most of the time, feelings are related to data. You just haven't thought deep enough about what your feeling really is about a certain decision.
So, but in that same context, I mean, the gut feel. A lot of people have had a great amount of success over their career because their gut said, now there's just as many failures, but their gut said, this is what I have to do, even when the data didn't support it at the time. And then to your point, the serendipity works out. How do you balance for you personally when your gut says to do one thing and the data says to do another?
I look for more data to try and figure out what I'm really feeling here, and maybe I don't make the decision, like, unless I have to, right? But I'm sure you've heard stories about this. There's a big private equity-backed E&P company a few years ago in Denver, that the CEO, the team came to him with all kinds of data, and they said, we should drill these 5 wells on this property in these 5 locations. And the CEO said, I don't know, I feel like it should be in these locations, and picked 5 different ones. So he went completely against all the data, and they were all dry holes. And that's the way decisions have been made historically, and I just think that there's no way to go back and decide whether that decision was a quality one or not, because there's no data supporting it. There's no ability to adjust the process going forward. So you're a one-off situation. Yeah, it works out sometimes, but it's very much a depending on where the decision is being made. It's very much, I think, data and process driven.
I like the way you talk about that, because one of the things I think that leaders do poorly, especially in this day and age. So not in the 80s when, quite frankly, I remember my dad coming home from the office with a briefcase of paper. And if you have a briefcase of paper and no control F and no email and no communication, the reality is it takes you 2 weeks to do something that we can probably do now in 4 minutes.
Yep.
But the generational leaders of the 80s seem to value consistency because they didn't have the opportunity to over communicate with people and to get as much data as we do now. And so I've always viewed that the leaders who are consistent to a fault, where they're not reflecting on the data, like even the E&P companies, when March 8th happened, and that was it's March 7th, but the backdrop of the Russians not doing, Saudi not doing, and then 10 days later, COVID, and March 23rd, the world blew up. The fact that it took Exxon like 45 days to cut their budget is so crazy to me, because they knew what the answer was, and it felt like they were just trying to be, well, we're a long-term value driver and we ebb and flow through the cycles because that's what we did and that's what we've always done. But they didn't react to the data that everyone knew they had to. And even politicians now, they're so baked into this. Well, case counts rising. Well, but are deaths rising and are hospitals full? Those are the two actual criteria. And yet, we can't change the narrative. How do you think that people can improve themselves in that category?
So in the Exxon scenario, one is, I think I'm surprised they don't have all these different scenarios worked out. As a public equity investor, we constantly had scenarios. If this happens, how will we react? How does it change our thesis? And you try and go through those, so that way you already know how you're going to react. I mean, it seems to me fairly easy to say, if something happens with price and something happens with supply and something happens in the marketplace, we're going to react in this way. I'm surprised Exxon just doesn't have a playbook ready to go that you can make a decision within 5 minutes, because you've already discussed it ahead of time when you're not emotional about it as well. And I think with other decision making, and we're seeing this is a great experiment in decision making, this COVID period. And I think information was heavily uncertain, and it is dynamic and changing. And what is the framework for the decision making? We're going to do XYZ with these factors involved. And as those factors change, it changes the output. And there needs to be some sort of smoothing mechanism, so that way it's not like this, your output. But I think that would drastically change what we're doing today. And I think that it would avoid the sunk cost bias that I think exists today, the save face. I mean, if you're a public health official, you have certain metrics for what you decide. And if you're a politician, your job is to take that information, synthesize it, and make difficult decisions instead of just going off of whatever you're told. What happens when the information changes and you look like maybe you made a wrong decision, which I'm not saying you did, but if you made a wrong decision, and you don't have a process, and you don't want to admit that you made a wrong decision, so you delay updating your output. And I think that's part of what we maybe see today or will see in the future with these types of decisions.
Well, I think we've certainly seen it with Polis. And again, not because this is a political show, but we obviously are looking at leadership. And, as an investor, as a small business owner, as all these things, we're trying to read the tea leaves as to what the heck's going on. And Polis, I felt early on, did a really good job of communicating and saying he would constantly look at the data. But then subsequent to that, he's just been absolutely absent and not changing anything. And it is, again, I understand politicians have to be elected, which is a very hard factor, and that the media pushes a narrative that they want to outdrive a political outcome. But it is fascinating to me how even people who knew they should be data driven, like Polis, has totally walked from the data because it's showing a course of action that I don't think he wants to take. So he's deferring the decision.
Yeah, and what's the decision making framework? Articulate that. If you communicate the decision making framework, and this is from an executive down to politicians, to anybody, communicate that decision making framework. This is how we are making this decision. When new information comes in that changes these parameters, we will have a different outcome, or we'll maintain and stay the course. That way, everybody knows what data we're looking at, and we're going to update it as new data comes in, and we then collectively can debate the decision-making process instead of debating the outcome.
Yeah, absolutely. So if you could go back to your younger self and you met yourself 15 years ago in some sort of frack to the future, fun time travel experiment, what advice would you give yourself that would positively change something? And I know it's a hard question because we talked about it before we went on air about your child who's 6 months old. Daughter, is that right?
The son, yeah.
Son. And obviously you never want to change the family dynamic by making a different decision. But if you abandon those and you just told yourself, hey, you need to think about this, what would you say?
I would say I, at that point in my life, underestimated the value or the social need of credentials. And I think that I would take that a touch more seriously. Like today, I'm a CFA charter holder, but I got that later in my life. We judge people whether there's the world as it is and the world as I want it to be. And I, at that age, which I think many young people do, focus on the world as I want it to be. And I think that I would have been more receptive to the world as it is and understanding it a little bit more and bridging that gap a little bit better. So credentials is one example of that. The other thing too is when I was young, I traveled quite a bit. Like I in high school, I in essence snuck off to India and Nepal and stuff, which is a longer story. But I stopped traveling from about 2000 until at least 2010. And I think that seeing a broader world, I was very focused on career, but seeing a broader world as much as possible, and that can be through travel, through reading, through experiences with other people. As a trader and an investor, we sat in a room with 4 people and kind of hid from the world, because when you have a strategic advantage, you become paranoid and don't want anyone to know about it. So I think that I would loosen up those behavior slightly as a young person.
Now, it looks like you read a lot just based on your background. You certainly have a lot of books.
Yeah.
And you mentioned a couple books in the show. What are some really key books or things that you read that come to mind as game changing for you?
Sure. I think one of them is a book called The Success Equation. It looks at basically outcomes, skill versus luck in sports, in markets, in investing, and those types of things. And I actually steal that luck and skill bucket component from that book, or I learned it from them. He talks about a fascinating topic called the paradox of skill, which I think everybody should learn about. It's very insightful. So that book, I think, changed the way that I think. And that's a great piece. I think I mentioned it also, Super Forecasting. It changed the way that I think about forecasting the future and what that really means. I think Modern Monopolies changed the way I think about businesses and strategy. So there's 3. I could probably go on forever. Howard Marks, I think, is one of the greatest investment philosophers out there. He's part of Oaktree. And
I agree.
He writes regular memos that are free on his website, Oaktree, and I would recommend anyone interested in investing to read those memos. I think that they're very important.
I totally agree. And actually, it's funny that everyone talks about the Warren Buffett letters. And again, you talk about skill versus luck. And clearly, he's a very skilled investor. So I don't take the Dave Portnoy view that Buffett's washed up. But I also think that, he started investing really post World War II, when Europe was rebuilding and America was building an economy without competition. And we were able to do things over the course of Warren Buffett's career that, my grandmother had bank stocks and she just absolutely killed it. So, obviously there's a lot of timing added to, you could be the greatest investor ever in the wrong cycle. Like if you were an energy investor from 2014 to 2020, it's been really hard to make your bacon. But if you've been a tech investor from 2014 to 2020, you've kind of done pretty okay.
Yeah. Yeah. And so did you make the decision to be a tech investor versus an oil investor, or was that just assigned to you? Did you look at the macro landscape and make that decision? So those factors come to play too. And I think one of the clear advantages that Warren Buffett has had, and it's well documented, is the structural component has allowed him to take advantage of things that other investors were not able to take advantage of, just because he didn't have inflows and outflows of capital.
Do you think, last question for you, do you think, based on your investment career, that the investment game is rigged? And the reason I say that is with the rise of Robinhood and the talking heads would certainly say there's a lot of momentum investing that's day trading. And I remember it very clearly from 1998, 1999, 2000. Everyone thought they were an investment professional, and you'd buy pets.com. It would IPO, it would go up 300%, and you were brilliant. But the pain that came when that bubble burst was unbelievable. So I'm curious what you think about, the inside information and the skill involved in large cap investing that gives a distinct advantage, or is it just structural because you have so much money, you have opportunities other people don't have?
Yeah. So like insider information, I think is less than it ever has been. I think there are structural advantages that people have. For example, if you want to participate in the E&P opportunity, retail can't through debt. So a retail investor just is too small to participate there. So there's a structural issue. For quantitative trading, scale matters. It certainly does now, where it didn't maybe 10 years ago. So there's structural. Doesn't mean that it's rigged. And then like for us in 2010 to 2013, the exchanges were creating, an order type a day. So different order types allowed advantages. That I think is and was manipulation, and to certain people's benefit. That has since dissipated. So I don't know that I think that it's rigged per se, but I think there are certain structural advantages. Now, this alludes to one thing that I said before, which is the paradox of skill. And as skill increases in any endeavor, so all the basketball players' skill increases in the NBA versus college versus high school, the standard deviation of skill decreases. And what happens is luck or randomness becomes the bigger factor for outcomes. Now, basketball is maybe not the best example, but it certainly is true with investing. As the skill and the information increases and the ability to analyze that information, randomness dictates outcomes more. And I think that's what we're probably seeing in public markets. And it's part of why I left public markets. There is in private markets, there is information asymmetry. And there are many more advantages in this space for an investor to add alpha above market type returns, whereas in public markets, the ability to add alpha is very low, and it tends to be more structural than insightful.
That is a great way to end, and I totally agree. I think that especially in oil and gas, the private is the way to go. And regardless of how this evolves, I certainly see one of the consolidations to be to see a lot of public companies actually go back to private, because the advantage of being public now with no access to capital markets is there is zero advantage to that. And so it'll be very interesting. David, I really enjoyed the conversation today. I think some really good thoughts on data and some books. And I like the way you think through data and challenges in making a decision. I think that that's really cool, and I wish you all the best in finding the next digitization oilfield game changer. So thanks for joining us on the Hot Take of the Day podcast.
Yeah, thank you, buddy. It was great to be on.
Excellent. As always, you can catch up on our old episodes wherever you catch up on your podcasts. Write a review. Let us know how we're doing, topics you'd like to hear about. And until next time, be safe, be good, have a great day, and bye for now.